Hi, good afternoon, everyone. Welcome to the Self-Assessment Masterclass today. Thank you all very much for attending. So what we're going to talk about today is, firstly, what is a self-assessment? We'll then look at the important filing dates and the financial dates. Do you need to file one? That's a big question that I hear asked quite a lot of times. It can depend. Sometimes it's down to HMRC's discretion, but more often than not, the answer is going to be yes. So we'll cover that in more detail. How do you register for self-assessment? Now, this is something that, especially as new starters, you might not even realize you actually do have to register to do self-assessments to begin with. Now, the information that's included on self-assessments we will cover. So we'll let you know, what needs to be put on there, what type of information you need to have ready. Again, that moves neatly on to how to start preparing for it. And then lastly, how can we help? If you want our services, then yes, absolutely, we can prepare and file self-assessments for you. Yes, Amanda, just to answer your question, the recording will be available to watch again afterwards. So just for everybody else here, if you do want to refer back to this later, we are going to be uploading this onto YouTube. So yes, by all means, it will be on there for you to have a look back on. So, Michael, was there anything you wanted to add before we move on to the first point?
No. Seems straightforward.
Perfect. Right, so let's get the ball rolling. So firstly, what is a self-assessment? Now, again, as I've just mentioned, the recording is going to be on here, and I am going is going to be on YouTube, and I am going to upload these slides as well. So by all means, read back on this at your own leisure. Now, I won't read this word for word, but in a nutshell, when you look at self-assessment against, let's say, employment, for example, now, as an employee, when you get paid, all of your taxes are deducted at source. So that counts for national insurance, that's income tax, for example. When I get my payslip at the end of the month, I don't need to do anything. That's all taken care of for me by my employer. Now, on the flip side with self-assessment, because you're self-employed and you're earning income outside of PAYE. Now, as a limited company, yes, you can earn through PAYE, and that's how a lot of directors will take their salary. But you can also have dividends. Now, dividends, just as an example, are what are called undeclared income. Okay, so HMRC will only actually know about that outside of PAYE income when you tell them about it. Now, for sole traders, you don't earn anything through PAYE. Okay, you don't take a salary per se. So in essence, all of the income that you earn is deemed undeclared, again, until you tell HMRC about it. And you do that by declaring your income through a self-assessment. Okay, so it's really important to remember PAYE and self-assessment are different. Okay, they're separate. Yes, they're similar. It's still a way of reporting your income, but the way that's actually done is different. Okay, Michael, did you want to add anything further on to this?
Yeah, although the PAYE is different, for those who are, let's say, company directors and the rest who might be getting a bit of PAYE, when it comes to your self-assessment, that information will still be required. We do get a question as to, but I've already paid a tax on that. Why is this needed and the rest? And the simple answer to it is that when we are computing your taxes on a self-assessment, we basically need to recalculate all of your income, and then the taxes you've already paid is basically deducted from the tax you have to pay. So that's the way it basically works anyway. Everyone gets a personal allowance, which is $1 a year, and you'll get it through your PAYE. So that is being factored into your self-assessment. So yeah, that's the extra bit to add anyway.
Perfect. It's just to double check though. So even though PAYE does get reported on a self-assessment, you're not obviously going to be double taxed for it then, are you? It's just a way of saying this is a bit of extra money that I thought you should know about, but they'll know it's already been taxed. So in essence, you're not going to get double taxed.
Yeah, because what it does is that I think it's more to do with a personal allowance. So at the moment, the personal allowance is 12,570. So when you are in employment, your employer, before they pay your amount, will deduct a proportion of that personal allowance. Okay, so that is being done through your employment. When you come to self-assessment, imagine that you basically not included your PAYE income in your self-assessment. What would happen is that you have an additional 12,570 or personal allowance being deducted again from your income. So on that basis, one individual has the ability to claim 2 loads of personal allowance, which isn't right. And that is why you declare all of your income, all of the taxes you've suffered, and then everything will be recalculated again with just the one personal allowance in there. Okay.
Got you. Perfect. So yeah, and that's self-assessment in a nutshell. Just got a question from Les. I use Crunch for my accounting and self-assessments. I submitted it, but I'm being asked to review and approve it. Good question, and we are going to cover that. So don't worry, that will be covered, and we'll let you know exactly what you should be looking for, what you should make sure is on there, what you're claiming, and so on. So hold fire, and we'll get there. So the next section is about financial years. Now, I mentioned earlier, there are different requirements depending on whether you're a limited or a sole trader. Now, universally, when it comes to self-assessments, you will share the same dates. Okay. Now, without getting too confusing, limited companies will be well aware, that they have an accounting year. So this is when their business profits are accounted for. Self-assessment is all about your personal income, not business. Obviously, with sole traders, because you don't have a limited company and you don't have year-end accounts, this is where actually all of your income, so everything you've earned through that business, is accounted for instead. So the important dates to remember for everybody are the 6th and the 5th of April. So the financial year always is between the 6th of April to the following 5th of April. And this is when all of, everything that you've earned, dividends, sole traders, and so on, is reported. So those are the dates that you've got to consider. When it comes to the filing, however, this is where it can get slightly confusing. So as an example, you'll see here on the slide. So let's take the financial year of April 2021 until the following April in 2022. Now, the due date for a self-assessment is always the following January in the next year. So as you'll see in this example, financial year 2021 to 2022 means that your due date for self-assessment is in January 2023. Okay, so keep that in mind. So you've almost, don't quote me on this, I think it's about 9 months, isn't it, that you've got actually from the end of the financial year to get your self-assessment filed. Is that right, Michael?
Yeah, roughly about 9 months or so. Yeah.
Okay. Again, I've given you another example underneath here. So for the following year, 2022 to 2023, that means that one will then be due in January 2024. And it just keeps going like this. It's like a revolving door then of self-assessments. Now, there is one thing that you should be aware of, and Michael will be able to give you a bit more detail on this, is that there are some changes to the way that self-assessments are done, which are coming into effect in April 2024. And this is just by way of how they're submitted. All right. So it's under the government's new plans of making tax digital. So we won't dive too far into this because I appreciate it's some time away. But Michael, do you want to give a brief breakdown of what these changes are and what they could mean?
Yeah, in summary, basically, it's the same self-assessment that you'll be filing, but the government is kind of looking at counting its money earlier. So it's trying to simply break up what, let's say, you file annually into 4 quarters. Okay, so that if, let's just say that the government knows that, okay, in your first quarter, your tax you should be paying us is roughly around 2,500, and then the following quarter you file again, and then they know that there's an extra, they can plan and then know that, okay, we expect to receive X amount. So that is what the making tax digital for income tax is. They would effectively get you to file 4 self-assessments, okay, or break your income down into 4 quarters. And then by the time you get to, let's say, the 31st of January, it's more about your filing a final document just to say that, okay, I've had these 4 quarters, and then if there's any adjustment to it because maybe you didn't work in the last month, or maybe you worked too much and then you got your bonuses and the rest, there'll be final adjustments and the rest in the final month anyway. But essentially, it's the same self-assessment broken into 4 chunks to be filed quarterly, just like VAT returns. And then there'll be a formal declaration after to close it all off, and that's it.
I'm with you. Say, I was just thinking it sounds very similar, like what they're doing with VAT returns at the moment as well. So, I mean, Les has just said, and it's quite a good point, the gov are spending it faster than we can make it and getting taxed on it. I mean, that's it in a nutshell, I think. There is a question here from Alan, who is a higher rate taxpayer. Does the Crunch platform calculate and claim additional tax relief on pension contributions automatically? Michael, over to you.
Yeah, there's, in terms of doing our self-assessment, we currently have what we call the auto-generate function. So some have a simpler self-assessment, which our system does automatically. With those who are probably claim the higher tax rate relief and all of that, that will be more of our complex one, and we will do it on a third-party software, but then an accountant will simply go through, claim those reliefs and the rest. So in most cases, our accountants are, let's just say, clued up on this. If anything is missed and the rest, the client could always come back and then say, okay, fine, I paid additional rate of tax and the rest. Why has it not been included here? It goes back to the question that Les was basically asking about why are they being asked to review their self-assessment. Is because clients provide us with information. We obviously put it into a system, do computations here and there, but obviously we are human, we are not perfect anyway. So there might be things missed in the rest. So it's more about things going through. But to go back to the question asked, yes, we do the calculation for it. And yeah, accountants will be able to do that for the client. Okay.
That's good. I mean, the way Crunch produces self-assessments, it's quite rigorous in respects that there will be questions asked, there'll be discussions had between the individual and the accountants to ensure that everybody's happy with what's being declared and what's being put on that self-assessment. So it's not, it's not, oh, here's your self-assessment, that's it, that's done. There is always scope to question, query, and correct perhaps anything that has been missed. Okay, cool. So I think we've got a good understanding now of the financial year. So we'll quickly move on to the next important question is, do you actually need to file one? Now, I briefly touched on earlier, it can sometimes be discretionary. Okay, now, generally speaking, and I'm going to put a figure out there, I'm going to say about 99% of people will need to do one if they are operating limited or a sole trader business. Now, there are some exceptions to this rule. One of the main ones, I'll go through the Q&As that I've got on screen in a moment. Let's say that you're winding down your business, you've stopped trading, or even if actually you haven't even earned anything during that year. Now, if you've stopped trading, it depends on whether you've earned income within that specific financial year. So again, just have a think about those 2 dates I mentioned earlier, between the 6th and the 5th of April. If you earn anything during that year, chances are you're going to have to do one, even if it's a £5. let's say, right? So you have to let HMRC know what exactly you've earned. If, however, you've earned absolutely nothing, as silly as this is going to sound, HMRC might actually still want you to tell them about that, even though obviously they're not going to make anything off of it. You're not going to pay any tax off of it. There's still this trace. There's still this paper trail then that you've told them. They now know about it. Everything's all good. Michael, I don't know if you can think of any exceptions to that rule. I think those are the main ones off the top of my head.
Yeah, to add to your point, I mean, I would even go higher with 100% for sole traders. By default, if you are a sole trader, HMRC expects you to file a self-assessment on an annual basis until you basically stop being a sole trader. So without a shadow of doubt, sole traders need to file self-assessment, okay? For those who are, let's say, limited company directors and the rest, there is a slim chance that they might not need to file self-assessments. But with that, HMRC have got a website where you can go onto and then you put in, let's just say, your income and the rest, and it can tell you. Usually, if they are earning dividends, let's say less than 10,000, and then their income as well from, let's say, employment and the rest is less than 50,000, then it could basically steer them towards the option of not filing a self-assessment, okay? But then I would always recommend that even if you don't need to file it, you should file it anyway, because what you want to do is that sometimes even HMRC at their discretion can simply write to clients and then tell them you need to file a self-assessment. And if you don't file it, you then get a penalty. So what is the harm in simply spending, 30 minutes putting a submission through just to tell them that I had zero taxes to pay this year?
Yeah.
Sometimes they call it a nil return. Okay, that means that you're simply filing a document to say that, look, I had zero income, I had X, Y, and Z, and then that's it. Okay, so it will be better to do that than to get the penalty and then start going through the whole process of trying to appeal and the rest. So yeah, that's
it's a good point actually, because I mean, ultimately no one likes penalties or fines. So actually, like you just quite rightly said, spending 30 minutes ensuring that you don't have those conversations with HMRCs or those big red bold letters that they absolutely love sending out to people, it's probably worth doing. As Latina actually asked a question just a moment ago, which tied in quite nicely to this, is if I stop trading as a self-employed and become employed, so becoming an employee, do I still need to notify HMRC, and should I still do the self-assessment? I think
yes,
we more or less just answered that question. So yes, if you are going from self-employment to being an employee, generally speaking, you would have had income, of course, from your self-employment. And as Michael quite rightly said, even if you haven't, it's probably still worth doing anyway. But once you've made that change from self-employed to an employee, that's when the PAYE from your employment kicks in, and you don't have to then do self-assessments afterwards as an employee. So a couple of questions on here. I think we might have actually gone over these, but one of the most common questions we get is, I haven't had any income this financial year. Do I still need to tell them? Again, I think we answered that. Yes, as long as you're listed as self-employed, even if you don't have income, worth reporting to HMRC. I'm just a shareholder. Do I need to complete a self-assessment? Yes. Shareholders usually take dividends, so that's an undeclared form of income, so that's not taxed on PAYE, and the only way HMRC will know about that is by doing your declaration of dividends on a self-assessment. Again, usually, Michael, you might be able to, we probably will correct me on this, it says here, even if you haven't taken dividends, it goes back to what we were saying earlier, doesn't it, I suppose, is they still just want to know about it.
Yeah, I think I'll need to find the link so we can add it to the slides before we send it out. But there is a link you can go to, put in your information, and then it will tell you whether you need to file a self-assessment or not. In some cases, it would simply say that you can contact HMRC And then they would basically kind of make a note on your system and the rest, and then you don't need to do the whole filing. But at least you need to communicate that to HMRC. Okay.
Okay, brilliant. Brilliant. And last question was just around trading, which again, we have covered as well. Now, there are, of course, circumstances that are wildly different to the ones we've just explained. So if you are ever unsure about anything, as much as everybody hates contacting HMRC, I'm just going to throw that out there. We all do. There's no point denying it, but it is always better to give them a call and just say, look, this is my situation, explain it to them, and they will be able to tell you, yes, you need to do one. No, you don't need to do one. Okay. But general rule of thumb is just always have in the back of your mind, I need to do this, even if it's just to close it off. Like Michael was saying earlier, you know, it's better to be safe than sorry. You don't want those nasty letters coming through. You know, it's going back to Les's point earlier, I guess, to some extent, they're quick enough, to take the money off you when they want it, of course. But, you know, when it comes to things like, you know, even paying you money back, maybe you get refunds from them from self-assessments, you will spend a day and more trying to chase that up. So just keep them informed, and then avoid any nasty surprises.
Yeah,
now,
look, I had an extra point on a question that was asked about switching between self-employment and then employment that was asked earlier on. I think the point to add also is that depending on when the individual also switches from self-employment to being an employee, the dates would then mean that they would, first of all, they need to notify HMRC that they are stopping being a sole trader. And in notifying HMRC, they also need to give a date of when they stop trading. Once they have that date as well, it will then indicate whether they need to file, let's say, self-assessment for just maybe the current year or the second year as well before they actually stop filing self-assessment. So the fact that you switch to being an employee doesn't mean that you automatically stop filing your self-assessment. It is dependent on when you stop being a sole trader and the date you've notified HMRC you stop trading, because that falls within a tax year, if that makes sense.
Copy that. Yeah, I'm with you. Yeah, that's fine. So yeah, I guess, you know, to reiterate the point earlier, keep them informed. Okay, just let them know when any changes. I mean, ultimately, HMRC just want to know what you're doing, when you're doing it, how you're doing it, and, you know, maybe get in trouble for this, but are they going to get any money from it? Okay, you know, that's one of the things, is they want to be informed. They want to know what you're doing so they know what they're doing. Now, a question here from Joanne quickly, just before we move on, is my daughter is a full-time student and has a part-time job on a self-employed basis. Does she need to complete a self-assessment?
Yes.
I think I was going to say yes.
She should have registered because if someone takes you on as a self-employed person as well, they might ask you for your UTR number, which is your unique tax reference number. Okay. Now, if to get one, that means that you should have told HMRC that you are self-employed. So if the person is doing that, then obviously, if you've got a UTR number, then HMRC will be expecting you to file a self-assessment. If, however, someone is working as a self-employed individual without having registered as a sole trader, the key thing to work out is how much they are earning. If it's below the £1,000, that's what we call a trading allowance. Okay, HMRC didn't want so many people just filing self-assessment without a need for it and the rest. So I think a typical example they used was someone basically just renting their car parking space during Wimbledon, collecting a few 50 quid here and there. So they introduced this trading allowance thing that if your income wasn't more than that, then you didn't need to file a self-assessment. But that is for those who haven't yet notified HMRC that they are self-employed. Okay.
Right.
So if your daughter hasn't earned £1,000 yet, £1,000 yet from that self-employment job within a tax year, and hasn't formally notified HMRC that they are a sole trader, then the answer to that will be no to self-assessment. Okay. If, however, she has registered with HMRC that she's a sole trader, then yes to filing a self-assessment.
Okay. Nice one. Thank you very much. Thank you. Shirley has just added an additional comment here as well. That is, sorry, bear with me. The questions are coming in thick and fast. Is says equally, if you start a part-time job alongside your sole trading, notify them. Yes, it's a very good point. Okay, so if you are employed and you've got a bit of a side gig and you are doing sole trading, absolutely notify them. Again, goes back to keeping them updated, letting them know what you're doing. So let us go. I can see that there are a handful of other questions. I'll try and get round to those when I can. And just be aware as well that any that do go unanswered today, we will get in touch and provide you with the answer to your question. So rest assured, they're not going to go into the abyss and go missing. So actually, this ties in quite nicely. We were just talking about registrations. So for those that haven't done one before, it's probably natural to think, okay, well, you know, I'm self-employed. I've told HMRC about that. That's about it. Okay, but there is a little bit of an additional step you need to do, and that's actually registering for the self-employment, for self-assessment, because yes, you've told them that you're sole trading or you've set up a limited company, but they still don't know that you're earning through that yet until you've registered for a self-assessment and start filing them. Now, the registration process is relatively simple. The link's on here, and this will be available for you to click on when we get you the slides as well. Once you've done the registration, you'll receive what Michael was referring to a moment ago, the UTR. So this is your personal unique tax reference number. I think it's about 12 digits long or something, but it will be on the letter that you receive. And once you've got that, you'll then need to think about setting up a government gateway account. Now, this is your own personal sort of login ID to HMRC's portal. You'll be able to keep tabs on things like your personal taxes, your self-assessments and things like that. Now, that process can be slightly convoluted. There's a lot of sort of steps. So you register for self-assessment, you then register for the government gateway. They'll then send you an activation code, which you've then got to pop onto the government gateway. So the registration for self-assessment, quite simple. It's the bits afterwards that get a little bit complicated. So Michael will have dealt with this far more than I have. So was there any sort of anything that you feel people should be made aware of when it comes to these sort of registrations? I think the registration cutoff date, correct me if I'm wrong, is the 31st. Yeah. Okay, that's right. That's right. And what does that actually mean? So if I was to say I started trading on the 10th of April this year, I would then need to register for self-assessment by the 31st of October in that same year. Is that right?
Yeah.
Perfect. Okie dokie. So what information should be included? Now, this is going to cover one of the questions asked earlier. So what do you actually need to put on a self-assessment? What really gets reported on there? Now, it can be confusing, admittedly, especially if you're actually doing it on HMRC's website. It can be quite complicated, but it doesn't need to be. So the key items to make sure that you've got at hand is that personal tax number that we mentioned earlier. So before you even start the process of filing your self-assessment, you have to have your unique tax reference number. Now, if it's gone for a walk somewhere, appreciate if you registered some time ago, it's probably been stashed in a shoebox under the stairs somewhere. Just call HMRC's personal tax department, and they'll make you jump through a couple of hoops in regards to security questions, but they will reissue the letter to you with your tax number. Make sure you've got your national insurance number at hand as well. Again, if that's gone walkies, I think most of us probably know this off by heart anyway, but you can, of course, contact HMRC and they will resend that to you. The important bits are the details of the undeclared income. Now, that's dividends, any interest on shares, for example. Michael, can you think of any others that might be worth pointing out here?
Yeah, look, the simple point to use is that it's all income. Okay, better to declare everything than not declaring it. That's what gets a lot of people into trouble anyway. So as long as you've got any income within the tax year, just declare it. An accountant or someone else might tell you that, okay, this is too much, this is not really needed, and the rest. That is being safe rather than not telling HMRC or accountants about some income that you might have. And this is something that keeps coming up because you sometimes come across clients who basically, going back to the employment one, for example, it was just pure ignorance where the client was thinking that, okay, because I've already been taxed through PAYE, I didn't need to declare that, and then simply declared what they believed hasn't been taxed, so I should. And then basically, a couple of months down the line, you then get HMRC letters stating that, oh, you haven't declared this income, and then we've recalculated your whole self-assessment. You don't want to have that. So declare everything. The one looking through it would basically let you know this is taxable, this is not taxable, or not.
I'm with you. I'm with you. So again, going back to your earlier point, it's better to tell them about more or less everything than to omit certain things that you don't think need to be on there. I mean, I suppose that's also true perhaps with things like pension income and stuff like that as well, is it?
Exactly. Yeah.
Cool. Okay, brilliant. Keep your records of expenses. We'll talk about what impact that has on your self-assessment, especially for sole traders, more so than limited companies. We'll go into a bit more detail on that as well. Again, just going back to the point just mentioned, contributions to charities or pensions that might be eligible for tax relief, that's important. And any P60. So again, just referring back to, if you are currently employed and you've got a side gig, make sure you've got some form of record of your P60s or your employment salaries and things like that. Again, it does say it's not an exhaustive list. There's many more factors that come into this, but those are the key things to be aware of. Coming up next, we'll talk about the differences between limited and sole trader. Now, again, this isn't an exhaustive list, but there are some very, very key differences between the two. Now, limited companies, of course, take dividends. Sole traders do not. That's one of the main things. Okay. Now, limiteds have the option to take both a salary and dividends. So you'll be earning through PAYE, and any tax that's due there will be deducted at source from PAYE, whereas dividends isn't. Limited companies do not report sales or invoice income on self-assessment. That's your business income, so that's a separate beast entirely, and that's what will impact things like your corporation tax and so on. So sales invoices do not need to go on your self-assessment if you're limited. Sorry, excuse me. And of course, limiteds have to file year-end accounts, which, going back to that point a moment ago, accounts for things like your sales, invoice, profits, and you then get corporation tax applied. Okay, so sole traders, on the flip side, works almost polar opposite. They don't file year-end accounts. You only actually complete a self-assessment where you would then declare all of your income. So that's any of your sales. So any invoices that you've had, any money that you've paid to yourself and so on, you do report that all as income. And likewise, I mentioned earlier about expenses. So the differences here are limited companies claim expenses to reduce corporation tax. Okay, so that any business expenses, they go through the limited company, it reduces the amount that they pay HMRC for corporation tax when their year-end accounts are done. Sole traders, on the flip side, will claim expenses to offset the amount of tax that they pay against their self-assessment instead. Okay, is that more or less the gist there, Michael? Anything you want to add onto those?
Yeah, expenses just reduce your income subject to taxes anyway. So if you look at it from a company point of view, when they have their sales or turnover and you reduce that by their expenses before they then have a profit, which is subject to corporation tax. For the individual or a sole trader, it's still them invoicing, taking off their expenses they have before they then have their income tax and national insurance contributions computed on the profits they make anyway.
Okay, perfect. Right, just going to have a quick look at the time. Okay, we're doing good for time. So towards the end, I can see there's a bunch of questions. So if we've got some time at the end, I'll quickly swing back and get those answered. Moving on to the preparation. Now, this is more or less what we've just been saying. Income. It's super important whether you're a sole trader or a limited company, and in making sure that your records are up to date. Okay. Now, one of the things to consider is that if you don't keep your records up to date, the worst thing that could happen is that you end up underpaying tax. Okay. Now, going back to my earlier comment is that HMRC are quick enough to want that money from you. Now, if you underpay tax, it's the worst thing in the world in their eyes. Okay, so you have to make sure that you've got your records up to date, your invoices are all up to date, your payments for them, if they've been received, are all up to date, and so on. Now, one of the great things, obviously, if you are a Crunch member, is that when you do a self-assessment with us, all of that data is already in your account anyway. So your invoices, the money received for the invoices will just get pulled through onto the self-assessment form for you. Yes, you'll need to double check it because you've got to be vigilant. There is some due diligence in that respect required just to make sure that the figures are what they should be. And obviously, if you realize then that there is some stuff missing, you could just go back and update your account and then it'll pull through for you as well. Expenses, again, make sure that you keep records of your expenses. Like Michael was just saying, it's a reduction on your taxes. So if you're not claiming expenses and you're not putting those through, you're going to end up paying more tax than you need to. Okay. Now, this, on the other hand, is the opposite of what I was just saying about underpaying tax. Now, they'll want any underpaid tax off you immediately, but if you overpay tax, different ball game entirely. You will spend a long time trying to get that money back off of them. And I have seen some scenarios actually where HMRC will try and say that, oh, we'll just keep the money as credit towards your next thing. Is that a thing still, Michael? Or is that
Yeah.
Yeah, I thought so. Yeah. So just don't play that game with them. Make sure that you're reporting your invoices correctly. You've got accurate records of your expenses to offset the amount that you pay. And then you won't have to play that juggling game with them. Now, again, at the bottom, just to reiterate the points we made earlier, sole traders don't have corp tax. Your reductions are made against your personal tax for expenses. Limited company, on the flip side, expenses reduce corporation tax and not personal. Okay, so for limited, the most tax efficient way that you could reduce your personal tax, in fact, is to give yourself a low salary. So pay yourself below the national insurance threshold. So you're not paying any income tax or national insurance contributions on that. It's completely tax free. And just take everything else as dividends, because dividends are taxed at a far less percentage than your national insurance and income tax is. Our advice generally, Michael, did you want to give I can give a very quick summary, is your low salary, you're somewhere in the region of, I think it's about $9,000 a year or something like that before you have to contribute NI or income tax. And dividends, I think you can take roughly, I think is it up to about 34,000 and you only pay about 8%, something like that?
Yeah, it's around 41,000.
Okay.
Yeah, just give me a second. It's 41,170. That's for the 2022-2023 tax year. But if we go to the 21-22 tax year, that was 41,430. And the salary figure we are talking about for 21-22 is 8,840, and for 22-23 is 9,100.
Okay, perfect. And that 41,000 odd, just to double check, is that the combination of salary and dividends together?
No, it's just the dividends. So remember, the basic rate is up to 50,270. So we are talking about taking a combination of salary. So if we take the 22-23 tax year of 9,100 plus the dividends of 41,170 to then take you up to the 50,270 basic rate threshold.
Got you. Okay, perfect. So last couple of slides here now, and I'll quickly try and get around to some of the questions in here, is basically, can we help? Absolutely. You know, if you're a Crunch member and you're already putting your income in, your expenses and so on, it's going to be the easiest process I think you'll probably have done, especially if you've tried to navigate the minefield of HMRC's website, is you just make sure your income's in there, your expenses are in there, you've reconciled and everything's up to date. You then simply go over to the self-assessment section on your Crunch account. Questions will automatically get answered for you. So your income will be in there already, your expenditures in there already, your salary, your dividends, and so on. So it's basically at that point a checkbox exercise. It's a case of just going through, skimming it and going, yeah, that's right. There are, of course, some questions that we're not going to know about. So things like perhaps personal banking interest that's being received, maybe charitable donations if you've got, income that's earned outside of the company or the business that you're doing at the moment, but it's very minimal in that respect. And if you're not a Crunch member, then we actually do offer a one-off sort of service. So it's a questionnaire that you'll complete. Of course, the caveat of that is that we won't have the information about your sales invoices or expenses. So you would need to have that at hand and start populating the answers manually. And for our, even Crunch free members, the same rule applies with the income and expenses data population. As long as you're putting all your data, even in Crunch free, the self-assessment will be a doddle. Okay, now if for Crunch Pro, if you've got any questions, obviously you've got the service element here, so you can give us a call, you can speak to the accountants, you can have that back and forth conversation about self-assessments. If you wanted to check anything, that's fine, that's part of your package. For Crunch Free, however, because there's no support element in respects of phoning or speaking to somebody, just to make you aware, there is a service that you can use called Ask an Accountant, and that's just in the add-ons section. So if you are ever uncertain, pop over to the add-ons section and you can book a call in with one of our accountants to discuss it in detail if you wish. Of course, if you just want to find out some information about the service itself, then we've got our website here at the bottom, so you can have a read at your own leisure on there. So I believe that's probably it. Michael, did you want to add anything to the last points here or anything additional that I've missed?
No, I think you've covered it all.
Perfect. Right. So this last slide, I'm not going to read for you verbatim because it's just a resource part. So we've just got help center links and some additional resources there. Again, we are going to send out the slides to you. So all these links will be accessible. Now I'm going to quickly whiz back through. We've got about 10 minutes. So for those of you that don't want to stick around for questions, I do want to say thank you very, very much for your time. I hope you have found this helpful and informative. If, however, you do need some clarity on anything, reach out to us, get in contact, have a look on our website for more info if you need it. But if you are going to hang around for some Q&A, then I'll quickly get through some of these questions now. There has been quite a few actually, so I'm going to have to, I'm afraid, pick and choose which ones to answer at the moment. Some of them seem a little bit more complicated for the time that we've got, but rest assured, any that do go unanswered, I will be in contact. Okay, so we've got a question here from Yin. Why is there a need to keep track of expenses? Michael, over to you.
Basically, if you don't keep track of expenses, then that means that you'll be paying more taxes. So let's just imagine that someone has, if your income from sole trade was basically 50,000, okay, and you've spent, let's say 10,000, okay, on expenses, accountancy, insurance, all of that, then in effect, what you are supposed to be taxed on is 40,000 because that is your profit. Okay, If you want to forgo that 10,000 and not record it at all, then you'll be paying taxes on the 50,000. And it's as simple as that.
Okay, perfect.
Okay.
Got a couple of questions here. I think it's just a little bit of confusion between claiming business expenses on self-assessments. Now, I think this could perhaps go back to, the differences here between limited companies and sole traders. So for limited companies, do you still report your business expenses on a self-assessment?
If we are talking about the individual, okay, then they will do it on their self-assessment. So let's just imagine that there is a company director, okay, who has been working from home but hasn't bothered claiming that through the business, okay. When they file their self-assessment, they can still claim the use of home in their personal tax return as a business expense. Okay, so when they put on their salary and their dividends and the rest, they can put on an expense for the use of home. With a sole trader as well, they can also effectively claim the use of home is going to be one of their business expenses. So both can claim it. But in this case, what we are saying is if the director has already had that claim through the company, then you cannot then also want to claim it through your personal tax return. That would be like having your cake and eating it.
Yeah, it's true. That is very true. Okay, can sole traders claim working from home? Yes, Dan, they can. I believe that was just answered. Absolutely, that's fine. I think another thing we'll say to point out as well, this sounds like a question of, business expenses versus personal expenses, let's say. So when you're a sole trader, you don't have, because you don't operate a limited company, there's no real reason or justification for you to have, let's say, a separate business account, a separate business bank account. Now, it's always wise to, obviously, it's better to, for oversight, to have your personal money in one and the money that your business is owing is earning in another. That just makes sense and makes it a bit easier, but there's no requirement to do that. So a lot of people will share the same account. They'll have personal bits and pieces coming in and out, and they'll have their sole trader earnings coming in and out. On the other hand, when you're a limited company, there is a requirement to have a separate company bank account to that of your own personal bank accounts. Now, of course, in both scenarios, there's always a chance that you're going to have business expenses being paid. But there also might be personal expenses for, sole traders more so. But for limited, there's that chance then that perhaps you're paying for things using your own personal bank accounts rather than using the business bank account. Now, the sort of general rule of thumb here when it comes to claiming expenses is quite simply, is it for business purposes? Regardless of whether you're a limited or you're a sole trader, you have to kind of step back a little bit and go, okay, am I actually paying for this for the benefit of the business? Or is it benefiting me personally? I know, just trying to think of an example here. Michael, maybe you can give it, let's say clothing. Okay, clothing comes up, I guess, quite a lot. Okay, let's take a really bizarre example here. And this is a genuine question I have received, is can I claim suits through the business? Short answer is no. I mean, there's a really strange, I guess, workaround to this, is that, the first question is, are you only going to wear that suit while you're working? Chances are, no, you're probably not. You're going to go out and about in it. You're going to go to parties or whatever. Now, the strange thing is that in theory, you could probably claim it, but only by actually branding the suit with something like your company logo, which, let's be frankly honest, I don't think anyone's going to ruin a good suit by branding it with a logo or stitching something onto a suit. I mean, my example may be way out of the park here, Michael, so tell me to be quiet if it's completely incorrect. But
no, I mean, it does illustrate the point anyway. I get that same question over and over. What HMRC does allow is for uniforms, okay? Because you cannot take, let's say, a uniform to social events or anything of that sort. So imagine nurses' uniform, or let's say doctors' coats and those kind of stuff, or you got your health and safety clothing, those orange ones. No, it doesn't look well in, what do you call it, a social setting anyway. So you do have clients who basically want to find out whether, oh, the t-shirt they bought in that shop, they want. No, you can't claim that. It's dual purpose. So yeah, HMRC doesn't allow it.
That's a good point. And that is something actually that's probably worth noting is what HMRC call duality of purpose. And this is where there's a shared, a mutual sort of thing between, okay, well, you could use it for business or you could use it for personal. So, one way to look at it is it wholly and exclusively for business purposes before claiming it? I mean, like Michael said, for sole traders, especially if you work in, something that requires health and safety gear, boots and things like that, then justifiably you can say, well, yeah, that is a business expense. I need it to actually legally perform my duties. So yeah, it's worth considering that. The next question, we've got a couple more minutes, so let's have a quick look here. What about capital gains outside of the business, Michael? So I'm assuming the question here is, do those need to be reported on a self-assessment as well?
Yes.
Yeah. Cool. It's a short and sweet answer. I like it. Good stuff. Okay. Let's see. Well, I think last one here. I'll quickly answer this last one because the other ones are quite unique and specific to the individual. So I'll get round to those. Greg's just asked, what about home office? Now, I don't know whether that question refers to equipment for home office, so buying stuff for your own home office, or perhaps whether it goes to the use of your home as an office. Thank you, Greg. So yeah, business expenses, chairs and screens. Yeah, absolutely. I mean, if you are using equipment for the sake of your business, again, you as long as you can justify to HMRC, well, look, I bought this because it is for my business. Let's take something a bit more extreme. Let's say reading materials, for example. Okay, now, if you're buying things like training materials and those are specific to your trade and you're using it to learn and to research and do with it, generally speaking, that's going to be fine. If, however, you've just bought the latest edition of Lord of the Rings, then that's completely separate. So I think as long as they're related, yes, equipment, laptops, computers, peripherals, for example, monitors, whatever it might be, if you need that to do your duty, you can generally claim for it. Okay. I think then let's get this all wrapped up then. We've got a couple of minutes, so I can't see any other sort of simpler questions that we can just oh, hang on, here we go from Maria. We've got one here. If there are two company directors in a limited company, is it 41k per director? So I'm assuming that goes back to our low salary dividend combination. And again, yeah. Michael, correct me. I'm going to speak for you here. The answer is yes, it's per individual, isn't it?
Yes, it's per director. But then what we also need to realize is that dividends are paid out of profits. So if the company hasn't got enough profits, then you cannot pay the 41,000.
Mm-hmm. Yeah, that's okay. A good point. Actually, is that as long as you have profit after tax. So once your corporation tax been accounted for and your liabilities for VAT and stuff like that, effectively the remaining pot then is going to be your profit. And as long as you've got that remaining pot after taxes, generally you're going to be able to take dividends. Now, be super careful not to fall into the trap of taking more than you're actually able to, okay? Because then that becomes what's called a loan. Now, I'm not going to deep dive into this because it can get confusing, but basically when you take more money out of the business than you're able to, it becomes a loan against you, which goes on something called, for a limited company, a director's loan account, which can then actually start negatively affecting you on something called a P11D, which is called a benefit in kind. So yeah, again, I'm not going to deep dive on that because There's a lot to it, but do be wary of only taking money out of the business that you are able to when it comes to dividends. The last point actually that's probably worth speaking about, I know that we're just hitting 1:30 now, so I am going to wrap this up, but I thought it worth pointing out is some of you may or may not be aware of something called payment on account. Now, again, without getting too complicated, for those that don't know, it goes back to our comment earlier about HMRC. Just, if you've overpaid them, they'll keep it as credit towards the next time that you owe them money or something. Payment on account is almost exactly that. Okay. Now, a payment on account is essentially, let's say you owe HMRC £2,000 for a self-assessment. Okay. What they would actually then do for the following year is just assume that you're going to owe them the same amount the following year. Okay. So they'll assume that you've paid yourself the same amount, you've earned the same amount, therefore your personal tax is going to cost you the same amount. So what they'll do is they'll project that onto the next year's self-assessment. And what they'll actually ask you to do is make payments in advance. So you owe them £2,000, but because they now predict that you're going to earn the same amount next year, they've said, okay, well, you're going to owe us £2,000 next year. They'll actually make you pay half of that with that £2,000. So you owe them £2,000. They've predicted that you owe them another £2,000 next year. So actually, they want you to pay them £3,000 for the self-assessment, even though you've reported that I owe you £2,000. They'll want an extra grand on top of that as credit for the following year, and that you actually have to pay by the 31st of January. So that's the deadline. You've got to pay that to them at that point. But then they'll want another grand off you in July in the same year. Okay. Now, again, I understand that it can be confusing, and actually it can be really scary for a lot of people when they first start out, because it's just an unexpected cost. It's something that you never expected to happen, and actually you might not even have the money for it. Now, again, if you're in a scenario where you literally do not have that money to pay this payment on account or credit, you've got to call HMRC and explain that to them, because otherwise they will expect that money off you, and you're going to end up in a scenario where you've underpaid tax. You'll then start getting those nasty letters. Now, we have got knowledge articles, so by all means use that link that I've got posted here and just search payment on account, or go on the help center and search payment on account for more detail on that. But that is something that I thought might be worth mentioning right here. It's not to put the fear in you, it's just to let you be aware that that is a possibility. And again, it's this whole sort of revolving door of credit that HMRC absolutely love. So just be super aware that that's something you may face at some point. Michael, did you want to add anything on payment on account? Was that sort of clear enough?
Yeah, it was clear enough.
Okay, good stuff. All right then. Well, I will get this all wrapped up for us now then. Again, for those that remain, thank you so much for joining us. I do hope that you have found this helpful. We're going to launch a survey at the end of this anyway, so let us know your thoughts. Please be honest. If you thought it was terrible, tell us it was terrible. If you thought it was great, even better, tell us it was great. But let us know your thoughts. Like I say, I'm going to put this on YouTube. We'll send you emails individually so that you've got quick access to that video, and we'll also attach the slides there for you as well, so you've got reference to all of this today. But again, from myself, thank you very much. Yeah, let us know if you need anything at all in the future. But I wish you all the very best, and have a lovely day and a great weekend when it gets there.